Good morning, everyone. Great to see you all here in this second webinar of our series about preparing early stage innovations to get investor ready. Today, we are focusing exactly on that topic, getting investor ready. To explain a bit, my name is Siebe Briers. I'm an expert at the European Forest Institute and also the deputy coordinator of the Bioregions facility. And it's my own and our team's pleasure to organize this webinar series for you. The Bioregions facility is a platform for interregional collaboration to advance towards a forest bioeconomy. Our member regions are the Basque Country, North Rhine-Westphalia, Catalonia, Bioeconomy Austria, and Castilla and Leon. It is thanks to these regions that we are able to organize this webinar series to support you early stage innovators to get investor ready. I invite you all to learn more about these regions on our website. Okay, then again, same as last time, our expert is Jan Debbit. He's a manager at Meta Group. He was already introduced last time, and with this, I just want to give the floor to Jan. Jan, please go ahead. You can share the screen and start today's webinar. Thank you.
And the first webinar, I've been trying to sort of go from a very high level of in what context investors operate, just for you to understand their incentives and the way they make decisions. And now we're going to go a little bit deeper into getting investor ready and what this really means. So what do you need to do before engaging with investors and during engaging with investors in order to convince them that you are investable? So I'll give a quick recap again about Meta Group in case you forgot. I'll also do a quick recap again of webinar one. I'll try to keep that short. And then we go again a little bit into the investor relay race. There are, even within the tiny subset that is venture capital in the context of the larger investment world, there are a lot of different players and they all have a different place in the relay race. Then we're going to do a little bit of a Socratic method, in the sense that I want to sort of bounce back the questions back to you. Key questions you need to ask yourself before you get into the process of engaging with investors. And then we look at the milestones that investors look for them to make the decision to actually consider investing in you. And then a little bit about presenting your value proposition, your story, as part of a slide deck. And then we have time for Q&A. As to Q&A, indeed, please feel free to ask questions in the chat anytime, and I will answer hopefully most of them during the webinar. But I also again want to invite you to add me on LinkedIn, send me an email anytime you have a question around fundraising. Happy to have a chat with you. All right, so quick again about Meta Group. I'll just go through this a little bit quickly here, but what my normal day-to-day job is to help research team on their innovation journey. And as part of that, we are very hands-on in supporting researchers in accessing market and financial opportunities. And that will be a mix of grant funding and equity funding. As you will see later, this combination is crucial. And we really think in the part from the concept of being a research angel. As you know, a business angel takes equity in a company and is a long-term partner in the innovation journey of any startup. And that's also the way we think about our partnership with any research team. It's not just project in and out, it's there for the long term. So we invest with competence, time, and eventually capital. We share the risk with the researchers ultimately and have this long-term commitment. We do this through our acceleration program, and in the sense that starts every time we do a project together or any engagement together, where it's anything from framing the potential of your solution on the market and implementing the go-to-market journey, amongst which on the bottom right you see access to finance is a key part. We do this as well through partnering in European projects, so mainly between TRL 1 and 6, the EIC Pathfinder and EIC Transitions. These are the Champions League of European innovation, and we are very proud to have built a very strong track record around these. But of course also Horizon Pillar 2 and any other Horizon type kind of funding scheme We are there as a dissemination and exploitation partner. And we provide the access and the funding itself as well. And that makes us so unique, this combination. So we have in our team partners of other funds. We have, of course, our own fund. You can see on the right here in the center, which is orbited around by these other structures that we are part of, business angel groups, but also pan-European platforms where deep tech researchers access business angel investing. So, for example, the AZEL platform, which is funded by the European Commission. And we have walked the talk, right? So, as you know from the first webinar, investors live and die for exits. This is the most important thing, and the way you judge success of any investment company. And we are very proud to have had very strong exits over the years of real deep tech companies. So we really know what it means to have a project start as a researcher, a research team, and then end as a truly mature company that will be either acquired or listed on as through an IPO. Now, indeed, today is part 2 about getting investor ready. So let's do again a quick recap. Again, as I said just now, finance is all about the interplay between those who have and those that need. Both need each other in that sense. For example, the pension fund needs to combat inflation, but also wants to get a return on investment. The factory needs upfront cash in order to make an investment for the long-term success. And in between those players, you have the financial industry, investors or investment managers, and they are all about buying low and selling high. It's really as simple as that. And that needs to be in the back of your mind anytime you engage with investors. They want to get in to get out. So this again, just to show you what a tiny percentage venture capital actually is of all the investment players in the world. Most investors work in the listed part of finance, so tradable securities which you can quickly exchange into cash. The venture capital is part of alternatives, and that's still what it's called. And venture capital is a tiny subset of that. And the key characteristics there, as you can see on the right, on the left, is long illiquidity periods. And then specifically for venture capital, it means investing in small rounds. So not majority stake in a company. You invest in startups. What is the definition of a startup? It's a loss-making company. And then that's why, one of the reasons why you need the power law exit. So that means that any investment you make needs to be able to return the whole fund. That means that one investment should be responsible for giving a return to the LPs that is competitive on this market. So VCs are a product of limited partners, so they are in between. You can say, well, why isn't the pension fund investing directly into a startup? Even if venture capitalists say, look, we are better in finding startups than you, and we're also better at managing the investment than you. Finally, so there's different phases in the startup journey, of course. At the very first stage, pre-seed and seed, it's very high risk. And then the later you go, it's less risky, and you see a different set of investors there. This is a relay race. And I think this is an important image to capture in your mind, because you need to think about the long-term funding strategy of your company. It just doesn't stop with the next round that you're raising. You need to look 10 years ahead, and what kind of investors do I need, and what are they looking for? And will you be giving your cards away too early? You will not be able to finish that race. But this is definitely something we'll come back to in the next webinar, where we really dive deep into the investment process. For now, again, I want to capture this image in your head, where if you look at how many startups venture capitalist funds see and how much they actually invest, that is a big funnel, right? So how do they go through this process? Well, I'm gonna walk you through, because the first block, they already eliminate 900 very oftentimes for very simple reasons, and I've been in that position. So key takeaways of today: investors have specific mandates, right? maybe they even like your company and they like you because they work for LPs. They are mandated to invest in a very particular industry, geography, stage. They can only invest with a certain set of money. So that's very important to know before you reach out to them. Then you need to ask yourselves, why do I want to raise equity? Why now? Other alternatives as well. And do I really want it? This is a crucial point because really understanding the investment journey and owning it makes you a whole lot more believable when pitching to investors. And you need to be sure of yourself once you get into it because people will sniff it, if you will. So I also said during my first webinar that a lot of the investment world is based around software investing, and that still sort of influences the notions, the assumptions we have around investing, a lot of the language we use. However, non-software companies actually should look for different kinds of investors who in turn look for different things. And then, of course, you need to prepare well. So have your documentation in line, of course, a great slide deck, and then the data room, because you need to own the process and own the momentum when you deal with investors. Okay, so let's start the investor relay race for every step, a different investor. So let me just take you right into the topic actually of webinar 3, because here you see in front of you the investment process. You contact investors, you send them a memo, you sign an NDA or not. More often than not, you don't. And then after those first contacts, you might be receiving a non-binding offer. Then you can say, look, the investors can actually look into your data room. You open it on the cloud, and then you've received binding term sheets. And then you choose one of the investors who has sent you a term sheet, and you say, look, this offer I like. And then sort of the control flips because then the investors actually have more power than you because they will be performing the due diligence and then can say, look, are the assumptions that you brought forward to me in the whole lead up to this, can I verify them with the data you're sharing, the contracts you are showing with the customers you have, the IP, etc., etc. And then if that all goes well, they will invest. But already at the start, contacting investors and the teasers, and that's really the topic of today, this often goes wrong completely. Because your position in the funding relay race determines which investors to look for. Again, all funds, if you look at below on the line below, are constrained by their fund size and their strategy, but also by the mandates that are given to them by the LPs. So I cannot tell you how often still every week I receive emails and LinkedIn invites of startup founders who not even write a message with their invitation, but most often they look for a kind of investor that I am not. I am still part of angel groups, so I invest in the pre-seed stage, but I have startups asking me for seed or Series A rounds. So they are wasting their time and they're wasting my time. And I cannot tell you how often this goes wrong. Startups and founders, entrepreneurs, researchers not doing their homework before actually contacting investors. And then you're, as we say in Dutch, 2-0 behind before the match starts. Okay, so understanding that every stage has different investors is crucial. Now, one thing about how we call these stages are this is not logical. This is typical financial language. The financial industry is very good at gatekeeping this very simple or relatively simple logic behind the things that they are saying by giving it really weird names. So why these different stages are called pre-seed, seed, and then series A, B, C. Don't ask me why, because I don't know. And don't ask me because if it's logical, because it's not. But this is the language we use. So pre-seed is often a way to call companies that haven't actually got any traction. It's really in the idea stage or pre-idea stage. Then a seed investment is also done at the stage when there is maybe very early evidence of that technology is working or that there is a small revenue traction. And then the Series A is the classic venture capital round, where it's all about investing in a growth engine. So you already have a bit of motion in your machine, and you just want to fill up the gas tank so that it can go quicker. But these are very different types of investors, different mandates, different capacities. And this is crucial for you to hold dear to your heart. So again, VCs are a product to other investors, and the industry determines what investors to look for. So this is just to show you the different sectors where VCs are putting their money in. And each bar chart here has different investors, right? So most of the investors, more so than ever, are very vertical focused. So if you are in a particular vertical, you need to be looking for particular investors. Now, of course, this comes with exceptions to which we'll coming to later, but just to drill this home for you, right? Different verticals, different investors. So also investors amongst themselves talk like this, right? So I worked in a venture capital company, and I made a nice AI picture of two people in Patagonia sweaters because they talk like this when they meet each other. And I think this is important for you also to know, because you can ask very similar questions to the VC. What vertical do you invest in? Is it in software, in impact, in biotech? Okay. Where do you invest? As I said before in webinar one, lots of European investors, venture capitalists, have LPs that are from the government, and those LPs give the investors only the mandate to invest in a certain geography. So very often you will see entrepreneurs from totally different countries asking an investor, can you invest in me? And then they say, yeah, this is important as well. And of course, then what stage do you invest in? But this is something we'll get to. But what are some of the minimal requirements you look for? So for example, the company I worked for, let's say, said we look for to invest in companies that have at least 1 million in recurring yearly revenue. Okay. But other investors will say, look, we invest in companies that have 100 customers. Lots of venture capitalists have this sort of first hurdle that they're looking for. In the software side, that's very often revenue, but in deep tech or in other sectors, that's other different hurdles. And then you ask, of course, how big is your fund? Because when you know how big the fund is, you can sort of divide that by, let's say, by 15 or 20, and then you know how much they can invest per round. And that, of course, influences if you should talk to them or not. And then, of course, and then an important part, which unfortunately I cannot really spend a lot of time on, but people in the research ecosystem know how difficult it is to find a consortium lead for their research project. This is very similar in the investment world because only give or take 50% of investors actually lead investments. That means that they lead the due diligence, but also lead the investment management part, which happens after the investment. So taking an active role in the board seat and tracking, reporting, etc., etc. Lots of investors don't want to lead. They want to be part of, let's say, the upside, but they don't want to be, spending money out of pocket to hire experts to do the due diligence, and they don't want to spend time on the board seat. So this is crucial as well. So checklist for you. This is a crucial part of him being investor ready before reaching out, because again, this goes wrong already on the left a crazy amount of times, right? Before you reach out to investors, you need to understand what sector they invest in, what stage do they invest in, how much funding can they provide, can they actually even lead investment rounds? Because you should be spending your time on finding lead investors, okay? And of course, where do they invest? Do they actually invest in the region that you are in? And then maybe during that first chat, the investor is trained to ask you a lot of questions, but you will show them sort of a powerful ownership of the process, which is the key takeaway from my next webinar, owning the process. You show them that you are on top of things by asking them, hey, what are your LPs who actually pay you? Okay. Or can you give me an example of the support you gave to a portfolio company? Can I actually talk to a portfolio company? This is not maybe in the first chat, but in the process. But also, where are you in your fund lifetime? So I said in the first webinar, you raise a fund, you said to the LPs, the lifetime is 10 years. So after 10 years, we need to pay you as much money back as possible. But we only invest in the first 4 years of the fund. And then we have a little bit of time to maybe use a buffer to reinvest in winners for an extra round. Sometimes you can talk to a fund which is way too far in its fund's lifetime. So you might think, well, they might not even have money to reinvest in me. Because then you also need to ask how many funds did you raise? Huh? Are they in their fund three? Do they have success in returning capital to their investors? This is a question you are as much obliged to ask to an investor because the investor will ask a very deep questions and personal business wants to you as well. Right. So let's see if there's any questions here right now. Can you develop? So Ignacio is asking, can you develop a bit what should be taken into account when selecting an investor? Their portfolio will offers include some requisites in terms of how to run the startup, maybe hiring a specific management team. This is a great point. So let me go back here. This is the difference between private equity and venture capital. Private equity is different in venture capital, if you look on the right side of your screen, in the sense that they invest often with the help of debt funding to take majority control of the company. And then they start hiring the CEOs, and then they, want to do their management stuff. The venture capital investor does not. Venture capital investors often take minority shares in the round. But you can see, let's say, if you dilute or let's say give away 20% of your shares per round, you can see that by Series A or B, you as a founder have left control of the company. So the investors then, maybe three different ones, but together they might have board control, and that would often be the point around Series A, B, just theoretically. So let's look if I have a better on Series A, B. Also, when it's more about the commercialization and the revenue machine more so than the technology, you will often have or sometimes have investors who are saying, look, to the founder, I mean, you can keep your shares, but the management needs to be changed into someone who is more comfortable in running a company of 50 people. I don't know if that's a good answer, but so this depends on where you are in the lifetime of a company. But very importantly, if you are in the pre-seed or seed phase and an investor is asking for a majority of shares and control of the management, then you know that you're talking to an investor that is out of the ordinary, and you should be very careful with them. Okay, I hope I answered that well enough, Ignacio. Please let me know if that's not the case. So let's move on. So investor readiness and the questions you need to ask yourself. So I took a picture from the internet with a man looking in the mirror because this is as much about really understanding what drives you and your personal motivations and your teams as much as the actual potential of your technology and your business. Because again, venture capitalists have a long illiquidity period. It takes a long time for these processes to mature. So first of all, also looking back at the power law, investors look to invest in a company that can carve a slice out of a market that is at least worth 10 billion euros or more. So first of all, you can ask yourself, does my technology and company actually fit this power law? Very simple answer, for example, is if your company is selling services or your time, then you know that your company cannot scale enough unless it's big four to reach the size that is required to make such a big exit for an investor. Then the second question is very importantly, can you find funding at this stage with lower costs and constraints to reach your next technical and commercial milestone? Because you can almost see the equity or your ownership as a sort of deck of cards, and you can only give away so many. If you give away too many at the start, that means that you will have trouble later with raising rounds. That's why equity is considered the most costly type of capital. And more profitable companies are very careful with giving out equity. They mostly like to use debt. But of course, you don't have maybe revenue at this stage, so it's harder to attract debt, so you give out equity. But then the third one goes back to the man in the mirror or the woman in the mirror. Do you actually want this? Do you understand what it means to raise investor funding? Are you ready to maybe drive the car, but hand the gearbox over to someone else, right? Are you ready for being married in a long journey of at least 10 years to build out a true global size company? Because that's what investors are looking for. So let's go through these questions one by one. Again, so can you reach a slice of a big enough market that can produce a power law exit? And more often than not, what you see entrepreneurs and research doing, they say they go on internet, oh, what is the size of the mycelium market? And then they reach one of these data providers and they say the global market for mycelium is 3.6 billion. And the CAGR, so the annual growth rate is 8.3. This is a big market. This is investable. Okay. But I don't know if that really means anything. And this is called in the investor language, the total addressable market. But what you should rather think about is actually what is my serviceable addressable market? And then you look at a very simple equation. What is the amount of target customers? Be very specific. How many units can you sell per year? Be realistic, ambitious, but realistic. And what is the price per unit? And then you reach a market size. And then you have a sort of a roughly idea, okay, in 5, 10 years, am I reaching the size that is actually investable with equity? And then the question, do you actually need equity funding to reach your next technical or commercial milestone? So again, on the equity side, most notably, choices you make today have far-reaching consequences in the future. Equity is by far the most expensive funding, if you look on the left. However, what equity does unlock, which is extremely powerful, is speed. You will be giving a large sum of money directly on your bank account, and you can really invest it in the growth of your company. You can receive way more cash, basically, in an equity round than you will ever get with grant or debt funding. So if your goal is to move quickly, or if you're in a market where that's a prerequisite, equity is a great way of funding your business. But of course, every type of funding comes with constraints. So if you go to the right side of your screen, you see of course grants, cheapest form of capital, but very competitive long lead ups, and you will be spending a lot of time with reporting requirements. Loans, also low cost of capital, but often ask for guarantees. So very often in the early stages, they ask for personal guarantees where the founder, famously has to give a part of their house to secure a loan or other types of guarantees. And often they want cash flow. Of course, they want the loan to be paid back by sort of cash flow. Or sometimes in some cases in the later stages, you can raise debt if you have raised also equity funding. Because, for example, in biotech, you need to raise certain rounds at certain regulatory hurdles. And then that debt gets paid back when you raise a new equity round. But this is a little bit later stages. And then, of course, equity, nice, a good amount of money you can get in one go. But of course, you lose ownership. This is maybe a little bit of a GIF that's going on too long, so please focus on the left side of your screen. But these questions you need to ask yourself before you start raising an equity investment. Do you prefer to build a company instead of focusing on your research or other career journeys? Yeah. Maybe your focus is really to become an academic. That's fine. Then you should look at licensing your technology or, giving your equity away or your away to a venture builder. Do you prefer to go fast or slow instead of slow? Yeah. Do you think about selling your company in 5 years, or do you still want to run it and own it in 20? Do you want to own 5% of a company that is a global leader, or do you want 100% ownership with all the benefits of a regional success story? Are you okay with someone else having their hand on the gearbox, namely the investor, while you are driving the steering wheel? And then most importantly, and that comes to the GIF, which I like this GIF because it looks like they're friends, but then they have like this sort of this weary look, like, are we on the same boat together? Do you co-founders have the same answer to these questions? Because this is crucial. Lots of companies, startups die because of co-founder problems. They don't agree on the basic journey they set out on. And these questions are therefore important to answer. But if yes on all of the above, let's go. Let's go for the investment journey. So, investor ready? Any more questions at this stage? So Bart is asking, suppose I need 2 million for machinery and company is TRL 6. Are VCs interested in this? This depends on other milestones, of course, and this is on the evidence you can give. So let's dive into that. I mean, I apologize in advance that this is sort of a high over theory almost, and the specific cases are difficult to answer. But I'm sure you have other milestones you can share, Bart, that might entice an investment. That's a bit of a vague answer. Apologies. So investor readiness. So what milestones unlock what investors? So for each stage, this is a bit of a busy slide. So just on the title, for each stage, there's a different milestone. And software investing, which is sort of the traditional venture capital investor, they have, sort of brought forth this language that sort of influences all startups and investors in the way they look at things. And software investors are all about revenue, basically. They look at traction and sort of the speed of traction. And investors in general love nothing more than traction. So this is also count for deep techs because, of course, ultimately a company needs to receive revenue. This is ultimately what makes a company sustainable. And for some industries that can be very late, biotech, of course, the most famous example. But in other industries, you can also already show some evidence of customer interest. But in software, you can start building, as they say it, very quickly and start acquiring clients very early. So it's all about traction. But for a long time, this world has gone a little bit crazy because for a long time, the gold standard in software investing was, okay, triple, triple, double, double, double. So let's say in year 2, you triple your revenue. In year 3, you triple your revenue. And then the years after that, you double your revenue on a yearly basis. And this speaks to, again, the velocity that investors look for because they know software companies need to reach that very big size in order to provide a return on investment. So if you look at the right, however, this is going quicker and quicker. So the whole software investor market is going a bit nuts because right now with AI, it's quicker than ever to reach 100 million euro in revenue with smaller amounts of people. So the growth curve of companies nowadays is insane. And you have this influencer in the venture capital world who is a bit outrageous, but sort of is quite successful actually, or very successful. And is always there for the hot takes, but he says it's dead, right? If I am an investor and look at companies, you have to go from 1 million to 15 million to 100 million in, let's say, 3 years. Of course, I'm not speaking today with software investors, but I thought I'd share this slide just to show you what is happening actually on the software side and what so how to sort of this window of what a company looks like is differing very rapidly. But just to drill down for you, most importantly, is traction. Investors love traction, and even though they're not in the software company, this is one of the strongest things you can show to entice investors. Now, in deep tech, milestones are differently. So Bart already shared, of course, his TRL 6. I don't want to bore you with this too much, but you are aware of the TRLs. It's way that NASA thought of to sort of get a sense of where a technology is in terms of its readiness to deploy. But just to show you that you have on let's say the deep tech side or the sort of science-based venture capital side, investors very quickly can ask a question, okay, what TRL are you? And that will influence the decision to actually engage in a conversation. Because again, they are mandated to look at a particular stage of the company. So you see TRL 1 to 4, more pre-seed, and then seed, and then Series A. So Bart, in your case, you're really looking for seed investors that indeed look for investment tickets of 500,000 to 2 million. And one way to look at this is sort of that at every stage, an investor wants to sort of eliminate a risk. So the pre-seed investors, they are looking at companies that have barely or zero revenue, but they want to sort of get a sense of the team being strong, which is basically the most important part of any investment decision. We'll come back to that later, but especially the technical risk, okay? So for example, Days Capital, one of the OGs in deep tech investing, is saying, does the technology hold reliable under stated conditions? Right. So are a couple of core assumptions sort of verified? And then at the seed stage, you want to sort of already provide a little bit more evidence of customer interest. So you want to sort of show them that you already have LOIs or pilots, sort of early traction in place where you test your technology not only in the lab, but also in a sort of to a degree real world environment. And hopefully already you have sort of evidence that there are actually customers that have willingness to pay and have the budget. Don't only want to, but also have the budgets internally in their companies to acquire this technology. And then on the later stages, theoretically, to a large degree, it's more about GTM. So this is a sexy word for go-to-market or commercialization or marketing. How do you sort of scale your company to a degree where you can grow your revenue with a factor that is larger than growing your employee base? So you want to sort of build a machine. And this is all about, have you hired the right commercial talent, or are you commercially talented yourself? Are you maybe already generating a large degree of revenue, et cetera, et cetera? So again, every stage, a different risk eliminated. This is the very short answer. Hopefully already relatively informative. So Bart is saying thank you. So that must be good news. Any other questions from the audience on what I've just said? Again, this is quite high level. How do generalist VC investors, Ignacio is asking, if that exists, measure technology and market risk? Must be difficult for them in many cases. Indeed. So there are, in fact, generalist investors. Yeah, the way I think the TRL to a degree is a good way of thinking about this, or the Amadeus Capital one has a great webpage on pre-seed investments. Yeah, I think it's a little bit a common sense answer, so I'm not sure if that's really sufficient, but they look, of course, to see if the assumptions you make around technology are properly tested in the right environment. So that's technological risk. And then market risk. I think what a lot of researchers do bad or are famously bad for is that they love their technology, but not the problem. and I'll come back to this. This is a very famous quote and trope in investing, but market risk is all about understanding your customer. So have you in time spoken to potential customers? Have you built relationships? Have you built evidence again that there's willingness to pay and that there's actually budget in the teams you want to sell to?
No.
Okay.
Thank you, Jan. But if you allow me to develop too, because you mentioned before that some investors don't want to invest in this due diligence. They don't want to be the deal investor. So do
Right.
venture capital actually do some research, or they look for a consultancy, third party assessment, or how this works?
Yeah. That's a great question, huh? Because especially in the due diligence phase, when assumptions need to be checked, they often hire external experts. So even in software investing, they would hire a very specifically focused due diligence experts. On the private equity level, this due diligence is done by, for example, a McKinsey. So this is a way of understanding. McKinsey makes a lot of money. How? By doing this due diligence at a large scale for private equity firms. So indeed, they will often offload that to expert, but that's an out-of-pocket cost. And of course, that's why lead investors are scarcer than you might think. But of course, in-house, they also have the quality to make it to weed out the most important assumptions.
Okay.
And this is very often already not necessarily on technology, but also on understanding the team, or is the team actually motivated? Because again, the most important investment criteria in the early stages is the team, the quality of the team, the motivation of the team. Are they incentivized as such, etc., etc.? A question from Anna. Sorry, you talked about TRL, and I have a language question related to it. TRL is not the only readiness dimension. Yeah, that's true. There's also society or system integration readiness that speaks about the likelihood of uptake by users. There's the market readiness, legal readiness, etc., etc. Do you feel that investors speak the language of various readiness dimensions, or do innovators need to stick another established discourse? I mean, that's very true. Some of the things you do mention, I do feel have more of an SSH, social sciences and humanities angle. I think all of these are useful for looking, let's say, in the mirror, if you will. Oh, this is such an important part of the investment readiness journey, looking at yourself in the mirror and your team and your business and thinking, are we actually ready? But I would say that pragmatically, most investors do use TRL as sort of a sort of a basic framework of understanding where the business is. Of course, they won't make the decision based on TRL. Maybe the analyst or the associate in its first contact with a company can do the checklist there, because that's also what I did when I worked in venture capital, is just basically saying, oh, very quickly, oh, look, you are TRL1, we are TRL6, so you're out, right? So it's sort of a way to weed out the first batch. Um, so yeah, I hope that's a good answer. But of course, the actual investment decisions are based on way more data, or even beyond data. These are people making decisions, and until AI is taking over everything, these are based on emotions, but also on what Daniel Kahneman might say is sort of internalized experiences that sort of become intuition, especially around team, of course. But I need to go on, or maybe one more question. Sorry, I heard someone.
Yeah, I just wanted to
Yeah.
clarify a little bit
Okay.
about. So I read between the lines of your response that you're advising not maybe to stick with the categories that the investors are used to in terms of presenting your competition analysis in a competition analysis, not in a society readiness framework. And so,
Exactly.
yeah.
No, 100%. No, this is a great point. Yeah. No, don't go with research frameworks to an investor. No. Yeah. All right. Okay, so presenting your vision and value proposition. And I thought just a great way of thinking about investor readiness is actually you building the slide deck yourself. So I've often sort of wondered how sort of deceptively simple sometimes this investment world works, in the sense that very often you need to present all that you've built and thought about every day, and the amazing science you are doing. You need to capture in a slide deck, and then you have a pitch of 5 minutes to convince an investor. And it's sort of almost unfair, but it's very often how it works. And it's sort of building that slide deck does sort of force you to think very clearly about what are the promise you have with the technology you're building, or the company that you're building. So the standard slide deck is between 10 to 13 slides long, but I think the 6 basic ones are sort of captured in the questions on this slide. So the problem is very important. It should always start with, because ultimately you need to sell to a customer, and this customer will only internally ask for more budget if they can convince their superiors that they are facing a problem that really needs to be solved. So this is crucial. How have you defined your problem, and not in a sort of generalistic society sense, because there's plenty of problems that especially researchers are very good at sort of attacking in a sort of societal way. But no, are there actually problems with certain actors that are willing to pay for it? So this is often also where science-based entrepreneurship goes a little bit wrong. Then, of course, the solution. Can you really emphatically articulate why your solution is game-changing? Because investors, of course, look for game changers. They want to change the world in 5 to 10 years, not in the next one. The team, of course, team is well-rounded. Is it capable? But most of all, is it motivated? Does it really understand what it's going up against? Again, looking in the mirror, or is it ready for a 10-year-long journey of building, where you share ownership with investors that want to exit with a profit? Then the market, as I said before, can you carve a slice out of a 10 billion market? Then, of course, the competition often really is not done well, I would say. Can you really clearly define what alternatives your potential customers have? Lots of competition is basically nothing, doing nothing. So what that's something really to also define clearly. And then, of course, the ask. Is what you're asking, does it make sense in the long-term strategy? In reaching the next milestone? Do you really need equity for that? How much do you need? And then, of course, the pricing of that capital will come later, and we'll discuss in the next webinar. But these are sort of the key basic questions you need to ask yourself to assess your own investment readiness. So now the famous one, of course, is the problem. And this is a trope in the sense that a lot of people love to say this, and it is true. You need to fall in love with the problem and not the solution. Startups and companies iterate all the time. Investors know that they will pivot enormously over the course of their 5 to 10 to 15-year journey. So teams need to be adaptable to this, but it's therefore also important because you're always pivoting to look for the problem that's most urgent for your customer. So you shouldn't be falling in love with the amazing technology that you're building. You should always look at the customer or the problem, actually. And this is a book that's written about it. It's a trope, but it's a key point. It's something that you really need to internalize with your team as well. And it helps to make it quantifiable, especially on the customer level. So not on the societal level, but on the customer level. Those who will pay for this technology are losing so much money or efficiency or whatever because of this problem, and this is how we solve it. Then the game changer one. This is also a lot what we do at Meta Group when we help them for the EIC instruments, EIC Pathfinder and Transition, because lots of researchers, rightly so, are looking for incremental improvements because they are also important, or sort of curiosity-driven research, also important. But for the EIC instruments, it's all about sort of telling a story about the game-changing nature of your technology. EIC very much works like an investment process, by the way, but this is why it's an instrument close to our hearts. It needs to be game-changing, 10 times better than what it's right now at the market. Really, that's the scale you need to think about in order to push away customers that have already a competition that has already built a very nice personal relationship with the customer. How is that sort of procurement department going to be convinced that they need to switch technology after they have had such a long-standing relationship with an incumbent? That's why you need to be 10 times better, they say, than the competition. And then, of course, defensibility. This can be IP, but also a sort of team competencies. And of course, scalability is important. Your revenue should be growing in factors larger than your employee count. Otherwise, you're just a consultancy company. So this is also a good way of thinking about your technology, but also talking about it. It's you need to be throwing on that sales hat here and there, saying, "Look, this is game changing, and in 5 to 10 years, this will truly disrupt current practices in my industry." Now, the team. Again, investors know there's going to be so many pivots and challenges ahead, from the mundane, customers not paying. Can you pay your employees? Can you fire your employees? Are you hiring the right people? Can you inspire your team to not fight each other and actually have fun and sort of are energized doing it? To the strategic, should we pivot the whole business model away to a problem that is actually more worth something to the client base that we are chasing? So many pivots, so many things going ahead. You need a team that is sort of motivated and capable and resilient to go for such a long journey. And that's why investors think the team is the most important criteria in early stage investing. So, of course, on your slide deck, in one glance, you want to sort of show the technical and commercial ability and track record. Often this is done by adding some logos or some key pointers, some key experiences. But ideally, investors sort of look for a mix in a technical founder or a business-minded founder, or sort of an other combination where the sum of its parts is very strong. And then, of course, on the sector, depending on sector, for example, in biotech, this would be incredibly important to sort of show which advisors you have in certain hospitals or something that sort of add this sort of authority on the subject and on the technology that you're producing. But of course, also in larger companies, looking at the team, who you've hired is evidence of the way you can inspire talented people to work for a company that maybe cannot provide the same salary as a sort of nice lifestyle job. So team is very important. So if you look on the right side, you see that majority of VCs actually prefer funding 2 or 3 founders, right? And this is changing a little bit due to AI. But especially if you're still in the early stage of building out your technology, it would be wise to think about, for example, having someone by your side with the sort of more commercial skills. What you cannot really show on a slide deck, but can during a meeting, is the passion you have and the drive and the relentlessness. These are all sort of evidence points for an investor that they think, okay, this person can really can handle the pressure and the long and winding road ahead. Of course, resilience, adaptability. Some people say, for example, that guy that I showed you on Twitter, this influencer and turned extremely successful venture capital investor. He said once, "I'm looking for people who had some degree of trauma or therefore chip on their shoulder when I invest." And this is sort of maybe again a sort of grotesque way of looking at it, but it does sort of speak to the degree in which investors are looking for someone who wants to prove themselves, who's ready for this journey of disruption. And of course, a lot of interpersonal and human type of decision making then comes in the way. And the sniff test, is the person actually an asshole? Might sometimes also be a reason for investors saying no, because they also, of course, commit to a journey of 10 years to be with you on monthly board meetings or quarterly board meetings and making difficult decisions together. So these things are also important, something you cannot show in your slide deck, but you should immediately sort of make sure to communicate verbally and non-verbally in your first meetings with an investor. Of course, then the market sizing, again, we talked about this, but you should be actually targeting a market that can produce a return for the investors that makes them competitive on the larger investment market. This is not a very visually attractive slide, but this speaks to what Anne has said about, for example, competition, that you sort of use the typical ways of how companies sort of think about how to place themselves in the competition. So you can do this via a simple scheme where you go on that sort of technology depth and price, sort of just to sort of show where you are. I think what happens often in Europe is that people sort of not do their desk research well enough when they look at competition in other countries. So this should be well understood. And then, of course, it's always not only about companies chasing the same technology innovation. It's your competition is also your customers actually not buying anything. And this should also be well understood. Like, what is actually the incumbent solution right now worth, and why are you able to unseat them? Yeah, and then the fundraising ask, sort of threading the line between ambition and realism, but it should be clear. And the reason I'm saying urgent is because that you want to own the process a little bit. I'll come back to that a lot in the next webinar. But this is a little bit common sense, but of course, what you need to be sure of is that you understand what you are asking for and why you need it at this time in your company. And yeah, it should not only be about investing in, for example, machinery, as Bart said, but also providing runway. Runway is a way of saying that you don't run out of money within a certain amount of months. So don't only raise money to file a patent, also raise some extra money to actually invest in a sales team. And then, yeah, traditionally they would say that in America they would raise a lot of money, and in Europe they are a little bit more capital efficient. I think in general in finance, the well-established theory that is having too much cash is bad for management, because you will invariably be enticed to do things that might not be productive to the long-term success of your company when you have a lot of cash in your bank account. So also be precise about this, right? And this capital efficiency, by the way, is also greatly evidenced by what kind of cars you are driving on the company account and the offices that you are letting. But a bit of a common sense slide, but of course, being investor ready is about knowing actually what do you want to raise for what for. And the most important or a very important point here is the relay race. Again, if you look on the right side, you see the data on how much shares you are giving away per round. So the median in the US is that on the seed round, you give away 20% of your company. If you know that your technology will only be viable and market ready in the sense that it could produce revenues to the degree it make your company profitable over a period of 3 to 4 fundraising rounds, you shouldn't be giving away too much shares in the first round. And this is often where it goes horribly wrong, that especially in the earliest stages, companies give away too much equity. And this is, of course, also the large famous point of contention between investors and university TTOs, where investors always say that the TTOs take too much equity, too much ownership of a company beforehand, which then endangers the several round fundraising relay race ahead. Not taking a stand on that one, because I also understand the TTO perspective and it's all a bit nuanced, but again, this is important. So other considerations, not my best slide, but as per webinar 1, I think what you need to understand is that I've built this slide deck again, sort of from the assumptions of the traditional venture capitalist looking for a power law exit. In my first webinar, I have talked about that some investors, based on their different incentives and makeup, might make choices that are also influenced by other motivations. For example, impact or things that they find interesting or like. But all of them do look to make a return on investment, but some have other motivations. And then finally, on the bottom left side, you see that part of investment readiness is building a data room. So at some point, you have the slide deck and maybe some other points of evidence, and that's how you entice and lure in an investor. But at some point, the investor is going to say, "Look, now I want all the evidence that you can give me. I want you to completely undress, if you will, and show me all the data that can support the assumptions that you have made." And that's the data room. This is now, in the past, this was a locked room in an office building where all the documentation was. Right now, it's just on the cloud, where basically anything from the contracts of your employees or the customers or your IP or your shareholder agreements should be all being nicely listed and put there, as well as the assumptions you made in depth about the market sizing and your competition analysis, all the things that you can't really integrate into a small slide deck should be all very clearly and easily listed there, because most of the time the due diligence is actually wasted as it is, as you know, for example, in building a consortium around the communication part, waiting for replies, another week is gone, etc., etc. So if you really want to own the process and actually show that you are prepared for this, you need to be ready with your data room before you start asking investors for an investment. And this means that because you're attracting new customers, maybe, or building new IP, or whatever evidence that you are building week by week should all be put in that data room. So that it needs to be live. And again, a crucial prerequisite of being an investor ready. So because I'm coming back to what we are discussing in the next edition, the next edition is really more about the investment process. I'll be focusing more on the due diligence side and the term sheets, which you can see on the right. But again, contacting the investors, sending your teasers, the first conversations all the way into the left are often already where it goes wrong because you are not well prepared. And being investor ready is about being prepared, of course. Right. Let's see if I have anything more. Yeah, so final remarks. So from the investor perspective, back to the importance of the team, you are investing in people, and maybe on the later investment rounds in Series BC, there's so much data, amazing Excel sheets. You can really put your quants at work and really understanding if this is a good investment opportunity. But at the early stages, when the team is so important, investing is very much an art as it is a science. And as a founder, you should play into that in the sense that storytelling is important, and sort of in verbal and non-verbal ways, giving evidence of your motivation, ambition, and resilience, and of course the degree to which you can ultimately convince customers to buy your product. This is all important, and storytelling here is a crucial part. So don't forget. And if you don't feel you are good at that, you should have people by your side who actually are good at that, right? And this is about understanding yourself, looking in the mirror, what are your qualities and what are not your qualities, and can you convince other talent to be on this ride with you? Yeah, Q&A. Let's see if there are some more questions from people. So this is Anne's question. You have put your finger on the problem that we see a lot. Research turned innovators often fall in love with the solution. Do you have examples how they can get beyond that? This is very difficult because researchers are trained to do this, but now they are sort of venturing into a new career path which rewards entirely different assumptions. So yeah, I need to be careful here with I think looking in the mirror and really understanding what you're up against and what decisions you are now making as to going from research to a company, you need to be honest with yourself. And you need to fully sort of internalize that you are entering a new world which rewards focusing on the problem, or in other words, the customer, more than the actual technological beauty or interesting thing you're building. I'm not sure if that's a good answer. Ignacio, thinking on the problem, can you develop a bit on impact VCs? Are there some nuances when dealing with them in terms of growth potential and profit and societal impact, where to find them? Yeah, this is of course true. I should have put this slide I used last time in this deck, but it gave evidence of impact investors that look for different metrics, not only, let's say, the biggest Grand Slam exit. I do want to say, though, that they still are chasing an exit, and they still chasing big markets, and they still look for great teams, and they still want you to be well prepared and ready. They also almost want to be intimidated by great founders in the sense that they are well prepared and ask the right questions. But indeed, impact investors look for different metrics, and where to find them. I mean, this is where you add me on LinkedIn or send me an email, and then we can look at this together. I have to say, Google and AI can do a great job, of course. But yeah, impact VCs are there, but family offices and business angels also have very often sort of similar, less codified motivations. Especially business angels, again, they are not dependent on the success of their investment for their sort of career prestige. They only invest in such angel investments. Normally, the rule is only 10% of their investable wealth. So they are excited. They want to be excited by sort of moonshot projects or impact projects. So, and business angels are also dear to us, and we can help you find the right ones in the right groups. And then is saying, I think already making explicit that this new career path requires different skills and will not work unless one is willing to change is really valuable. Yeah, I agree. Okay. Any other questions? Any tool or site to contact investors in forestry related businesses? I'm sad because in the first presentation, I gave a bit of evidence on a great website called Deal Room, which is free for startups and not free for investors, where there were a couple of very well built lists made around forestry sector. So for example, Deal Room. So if you look up on Google Deal Room forestry or Deal Room, for example, wildfire startups, there are some great lists there. Or you look, but yeah, a great way it would be looking at some amazing companies from the forestry sector that have made it. I've listed those in my first slide deck, and then look who invested in them, and then look on the portfolio page of those investors. That's a great way of starting. So I think the slide deck of my first presentation was shared to all registrants, so you can look back and look at that. Now with yeah, sorry, Sipa, go ahead.
Yes, thank you, Jan. It's maybe a stupid question, but thinking about the growth path and how this goes from pre-seed up to Series C, I'm just wondering how regular or irregular this path can be. For example, is it sometimes that one of these steps is skipped, so you go directly from C to Series B, or also that you have to raise twice in Series A, for example? So I wanted to know how regular this growth path is.
Yeah, no, this is to be expected because of course nothing will go to plan, and prolonged terms of hitting a wall be interchanged with sudden momentum. Especially of course, in the software business, momentum is everything, traction is everything, and will maybe follow a little bit more of a steady path. But in more deep tech fields, it can take a long time before you actually are there to produce a technology that can actually be sold. But yeah, Of course, you shouldn't be thinking about, of course, it will not go to plan, but you need a plan to sort of as a compass. And then you raised another point, which unfortunately I haven't been able to dive into sufficiently. But a lot of the ideal thing is that you raise a new investment on a higher valuation so that the investors that are already on your cap table can show to their LPs that they're already on paper making a profit. But often you need to raise at the same valuation in what is called a bridge round. And this happens very often. For example, you are running out of money or you have a cash flow problem because clients are not paying their invoices. So you suddenly have a dip in the cash flow, and then you cannot go to a bank or anything else, so you have to raise equity again. And that's why it's important on the first questions you ask to an investor is actually how much money do you have left in the fund? Can you actually do a bridge for me? Do you actually do that normally? This is a very good point, and happens more often than not. More questions. A question from Victor is how important is it for the founder to have one big idea compared to a set of smaller ideas? This is a good point. I mean, it really depends on how divergent this idea are. Is it based around the same technology? Again, also keeping in mind that investors know that pivots are all in the game. But more, I think in general, you should be picking your battles, focus upon focus, and choose one big idea or product. And this should, of course, be based on your belief and your enthusiasm, but also evidenced by knowing the problem, right? Which one of these ideas and technologies are actually solving the biggest problem in the sense that customers are willing to actually pay for it. This also is something we see a lot with researchers applying, for example, for an EIC Pathfinder or especially an EIC transition, is that they are not focused enough in saying actually what the problem is they will solve. There's so many applications imaginable in a technology. No, you have to choose one to three maybe, but no, you need to be focused. Focus your attention, because if you're chasing too many leads, where is your time going? So being investor ready is having made that decision. Of course, take your time to make the decision, but as soon as you start asking money from investors, you need to be sure for what you wanted and what milestones you will unlock. I think I had two more slides because actually in the lead up to this webinar, the EFI team has asked for you to ask some questions to me, and there were two responses. So maybe we can very quickly dive into that. And I'm not sure if those people are actually in the call, but I know that, for example, the company CESE4, if I'm saying that correctly, asked me basically, paraphrasing here, is it advisable to bring customers on board as investors? Not sure if the person is here and who might be.
Yes, yeah.
Yeah.
Pablo Samin from
Yeah.
CESE4.
Can you maybe very shortly paraphrase and maybe already give some more information on what the investor actually, what the investment could look like, or what their incentives are, or why?
No. Okay.
This is a public webinar, of course, so
Yes, of course. No, it's no problem. In one product we are developing, we have been doing a trial with a company like an early adopter. This company is willing to take part on the future development. But on one hand, it's good because it's a company that could help us a lot on the next steps of the product. But on the other hand, it's a competitor for other companies who are going to be our future clients. So I don't know if you have seen this situation before.
Well, it is to a degree, it looks like a corporate venture capital play, if you will. And I really, it's hard for me to answer because the proof will be in the term sheet they want to. So there's a lot of tricks investors have up their sleeve to which we will be speaking in the next webinar to sort of assert control not only over the daily operations of your company, but especially on the exit of your company. Because again, investors are all about exiting, right? Or that's actually something you need to think about. What is the long-term gain for them to be part of your ownership structure? And I think that the cheapest form of sort of getting money to invest in the growth of your company is revenue, right? So ideally, you want customer revenue to be paying for the investments you make. So I'm not sure to which degree they would still want to be a client if they are an investor. And things like rights of first refusal, these are a specific term you can look up, but can they actually block you selling your company to a competitor to them? And this is a trick they might want to use. So really it depends, but it goes back to the basic questions. What do they want and what do you want? What is the long-term capital raising plan of your company? And are they an asset or can they be obstructing next fundraising rounds? But I mean, it could be super interesting as well. Huh? It really depends on the term sheet, so that the actual the strings they attach to the cash they deposit on your bank account. So worthwhile to dive in a bit further. And of course, you can use them as evidence or a momentum builder to talk with other investors because all investors are wanting to make a return and they all look to each other. They are herd animals. So if they know one is interested in investing, you should always talk to another.
Okay, thank you very much.
And then we had Bagachera. This was I think I paraphrased it here, but it all came down to we are not sure if we should continue building more independently first before going on the investment route. I mean, to a degree, paraphrasing here, but already asking yourself that question shows you that you're not investor ready. You need to be sure about what you're doing before entering in talks with investors. Otherwise, you cannot, in non-verbal ways, sort of exude that confidence and that ambition that they need to be convinced to actually give their money to you. So I think it's always good to continue building, to build more evidence points, more traction, and then of course always think about actually if we have built sufficient evidence and or traction, can we use different types of funding to fund our next milestone? The equity funding should not only be the only way. The best way to invest is using your own revenue, and then the other cheapest way is grants, then comes lending, and then finally an equity investment.
Yeah, I have a final question. So thinking about this funnel that you presented from 1,000 innovators presenting something to an investor, in the first step already 900 don't go to the next step. How many of these is because they don't know clearly what they want, and how many is because maybe the numbers don't make sense or
Great point.
The technology is not there?
Exactly. No. I mean, it's hard to put a number on it, but let's say 50% of that 1,000. I mean, this is again, venture capitalists sort of want to show that that they have reason to be this funnel part in the whole investment process, right? So they also sort of want to show to their LPs that we're actually looking at a lot of startups, but actually looking, I mean, more often than not, they're not actually looking at 1,000, but they have looked at them, but very shortly. So a large degree of this 1,000 are actually one of those hundreds or tens of entrepreneurs that also come to my LinkedIn and add me and say, look, we're looking for this investment. Well, there's no fit with our mandate. So that's a very large part. So it actually, again, speaks to the degree of which so many entrepreneurs are not prepared enough and they're not doing their homework enough when they're reaching out to investors. All right.
Great.
It was a pleasure, everybody. Again, add me on LinkedIn, send me an email. Let's work together. And next week, we are going in depth into the investment process, where we are looking more in depth into, the term sheet and the strings attached that come with an equity investment.